The latest from JP Morgan's analyst in the UK is simple and sweet. Get ready. It's nearing the time to add back risks. In other words, buy stocks so you can add to that shopping list. According to JP Morgan's analyst, the consolidation seen over the past few weeks has contributed to an improvement in a number of tactical indicators that were stretched entering the month. The strategists said they still believe that the market will advance into year end, starting with a September upward move. Reportedly, the positives are likely to be better technicals, a restart of the European Central Bank's quantitative easing, a possible bigger second Fed cut, and signs of an activity trough. So, let's take a look. According to JP Morgan, U.S. earnings growth has still been positive, rising 3% in the second quarter against expectations of a contraction, and second half consensus earnings growth estimates of 1.6% is rather conservative in their view. One other point is that U.S. earnings have only fallen meaningfully in the last 35 years when there's a recession. In other words, unless one is a subscribed believer in a U.S. recession over the next 12 months, one should not expect earnings to be contracting. And right now, well, we're not in a recession. And as shown by this chart, the Global Composite PMI has been declining, but the STOXX 600, which is a European version of the S&P 500, seems to be bottoming while the S&P 500 earnings growth appears to be gaining some strength. And as you can see here, the global composite PMI is the red line, where the STOXX 600 is the light blue bar, and the S&P 500 earnings per share growth is the darker bar. And as the earnings per share growth looks, it appears that there is a bit of acceleration in the last quarter. And checking back in with Bank of America's Merrill Lynch flagship bull and bear indicator, we see that it is flashing by. Back on January 3rd, when the S&P 500 closed at roughly 2447, or about 19.5% ago. So according to Bank of America, the positioning model recently tumbled from 2.4 to 1.3, triggering a contrarian buy signal for risk assets, that meaning stocks. Again, this is the first buy signal since January 3rd. And this chart here from Bank of America Merrill Lynch shows the history of the indicator and the January buy signal. If you remember, in early January, stocks were still feeling the funk of the monster December 2018 sell-off. On December 24th, 2018, the S&P 500 had fallen 19.8% from its prior September 2018 peak. Even though the S&P 500 is up about 16.5% so far in 2019, Bank of America is once again bullish. According to a Bank of America analyst, for 2019, we remain bullish on risk assets, particularly stocks and commodities driven by bearish positioning and bullish monetary policy. The trade war has thus far been bullish via lower rates rather than a recession. The positive news comes with a caveat, which is that Bank of America analysts are less optimistic for 2020. Reportedly, their view for 2020 is bearish for a multitude of reasons, including possible recession, policy impotence, and that bond bubble risks induce a big top in credit and equity prices as credit spreads trough and equity multiples peak. I say okay, and we'll cross that bridge when it comes. So for today, that's ChewDog Charts. Thank you.